The week starts on optimism that Thursday's inflation report from the US will be soft enough to keep the Federal Reserve those in charge of the market. Elsewhere, the Chinese authorities announced further stimulus measures to boost growth in China, and the barrel of American crude falls to $70 per barrel level. So welcome. This is Swissquote's Daily Market Talk. So the US equities followed up on the European stock market gains on Monday's trading session. The technology stocks in the US gained the most, and their precious contribution to the S&P 500 pushed the ladder up by more than 1.40% at yesterday's trading session as Nasdaq 100 rallied past 2%. Nvidia hit a fresh record on the other hand after unveiling new products to help PCs to boost their AI offer. And of course, not everything was bright at yesterday's trading session. Boeing, for example, was hit by a decent sell-off after a 737 MAX 9 model got temporarily grounded on an Alaska Air flight incident over the weekend, as you probably heard. And after United Airlines came to confirm that they also have found loose door plugs and installation issues on some other MAX 9 planes. Ouch. But other than Boeing and Spirit AeroSystems, which is a company that makes these problematic parts that just flew off, the overall sentiment was rather positive at the start of this week in risk assets. Now, yesterday's optimism in the market could be due to a couple of factors. First, the US politicians agreed on a 2024 spending deal that is seen as a key step to avoiding another government shutdown in the US at the start of this week. So the latter helped pull the US 10-year yield back toward the 4% mark. Then, the Chinese authorities actually pledged to lower the reserve requirements for the banks to boost the bank lending, and their promise to boost liquidity in China through open market operations and the MLF may have actually helped boosting appetite for the global risk assets, even though the Chinese stocks barely benefited from the People's Bank of China comments yesterday, as Shanghai's Composite remained actually under a decent selling pressure at the start of this week after Zhongji Enterprise, which is a shadow bank in China, filed for bankruptcy at the start of this week. And Xi Jinping promised to deepen China's anti-corruption crackdown on finance, on energy, on infrastructure, and on pharma. And that's certainly why international investors are not really willing to go back to the Chinese equities despite news of massive stimulus measures. Because when Xi Jinping cracks down on industries, he almost kills them. Now, the good news is, if you can call it good news, China's share in MSCI EM index fell to below 24% at the end of last year. So all gains vanished since the inclusion of Chinese A shares in this MSCI index. So why is it good news? It's good news because the spillover effects on other EM declines as Chinese shares dominance vanishes. So you have less chance to see the EM tumble because China does. And as we were talking last year, you can actually play these Chinese stimulus measures by not necessarily buying the Chinese stocks, but by playing long bets on industrial metals like iron ore and copper, as the demand for these metals to boost the Chinese industries and real estate is actually real, and they do have a positive impact on these industrial metal prices. Then the third reason which offers some optimism to the market seems to be the expectation of a sufficiently soft CPI report from the US this Thursday, and the persistent fall in crude oil prices continue to soothe investors' nerves these days regarding the future of inflation despite the exploding shipping costs due to the Red Sea tensions that are going on right now. And in this context, the barrel of American crude sank more than 4% at yesterday's trading session to nearly $70 per barrel level as Saudis cut the price of their Arab Light crude to Asian customers, citing rising global supply, the growing global competition in the crude oil market, and also the concerns regarding a slowing global growth and a slowing global demand. And well, indeed, the US shale oil production is near record right now, while the latest data from Germany showed yesterday that the German factory orders rose much less than expected in the month of November. So these two are backing the concern cited by the Saudis: high production and lower demand. Now, all eyes are on the US weekly inventories reports this week, which showed a 7 million barrel decline 2 weeks ago and another 5 million barrel decline just last week. So such big declines in US oil inventories are normally positive for oil prices, because when you have less oil, well, it means that you will have higher prices. But as you can see, even these decent declines in the US inventories couldn't actually boost the price of a barrel of crude oil. And it is certainly because the Red Sea crisis that's going on right now increase the cost of shipping oil from Middle East to other parts of the world and drive up demand for cheaper US crude. This is what's being said right now. And whatever it is, the negative momentum in oil prices persists, and a slide below the $70 per barrel level will likely pave the way toward the $65 to $67 per barrel range, which actually acted as a decent support level last year. Now, back to my inflation discussion. As crude oil prices have been one of the major contributors to inflation, well, their inability to rebound actually soothes inflation worries globally, keeps the Fed those in charge of the market, and that's, well, somewhat positive for the risk asset and the stock valuations. Yet Natgas futures actually advanced on deepening cold weather this January, although the surge that we see in natural gas prices is not significantly enough to ring the alarm bell for inflation watchers just yet. In the FX markets, while the US dollar remains offered, there is now a death cross formation on the daily US dollar index chart, where the 50-day moving average actually crossed below the 200-day moving average, confirming a negative technical formation on this chart. Now, there is, however, a lag in formation, mind you, and does not necessarily mean that we won't see the US dollar and the US dollar index rebound in the next couple of days. On the contrary, I believe that the dovish Federal Reserve expectations went well ahead of themselves since, well, the end of last year, and there is now room for some positive correction in the US dollar. And in the sense, well, the euro dollar will likely continue to see some decent resistance into the 110 psychological level, and clearing the 140 support for the dollar yen won't be a piece of cake. And even less so as inflation in Tokyo slowed from 2.7 to 2.4% in December, hinting that the Bank of Japan has little urgency to exit its negative rate policy right now, because price rallies in dollar yen actually do remain interesting opportunities to sell the tops for investors, because a slide below the 140 level will certainly trigger a rally on stops and gather a nice and beautiful downside momentum. But getting the timing right is crucial here, because the Bank of Japan is now expected to exit the negative territory by April this year, but nothing is less sure. If inflation in Japan is not an issue, well, the BOJ could well remain seated on its negative rates for a long time, because why not, right? If the Fed and other developed economy central banks left their zero rate policies behind, well, it was solely because inflation became unbearable in these countries. But if inflation is bearable in Japan, so you have no reason to leave the ultra supportive monetary policy behind, especially when the global economic outlook sours. So be careful with the dollar yen. It's a good trade, but the timing is key. Elsewhere, while Bitcoin extends gains to $47,000 level as Bitcoin ETFs get closer to approval. That's all over the news right now, and that will allow the finance giant names like BlackRock, for example, to invest massively in cryptocurrencies. Gold, on the other hand, has been under a decent selling pressure since the start of this year, as the rebounding US yields and stronger US dollar weigh on the precious metal since the start of this year. However, gold could well reverse its negative trend if Thursday's US inflation report comes in sufficiently soft, and that would help gold return past the $2,050 level per ounce. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates, and subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you actually enjoy them. So I will meet you again tomorrow, and until then, good day trading.